Well, perhaps you'd like to do something else and to spend your money somewhere else. Well, coming up after the break, we're going to speak to an investment analyst. She's going to tell us how she's using her money to
grow.
To grow. That's true. That's coming up right after the break.
Welcome back to the program. Now, Florida-based options trader Mirriam Macwilliams is no stranger to the world recession. In fact, she considers this period as a good time to make money, which she did.
The savvy investor managed to turn just $10,000 into $1 million back when the United States was going through a slump in 2001. So with the current global financial meltdown described as one of the worst in decades, we're going to ask her again just what we should be doing with our money. Good morning, Mirriam. Thanks for joining us.
Thank you for having me here.
What should we be doing with our money? Where should we be putting it?
Yeah, and let me just say this. I go back to the philosophy that the average individual person really should not be investing in individual stocks. Because you just don't always fully understand the mitigating reasons for the stock going down in price. However, investing in the market as a whole, maybe like incrementally investing in the spiders, which tracks the performance of the S&P 500, I think that's a fantabulous opportunity for individuals right now who are eager to start putting some of their capital to work after seeing this drop that we have had.
But how do you know which ones to choose? I mean, which ones to invest in? Because, you know, we're in a situation such that even blue chip counters, where we have trusted it for so long, are just coming down like that. And big names in America are just, you know, calling bankruptcy.
Exactly. Well, let me just say this, because in reality, from 2003 to 2007, our market doubled in price. It went from 7,000 to 14,000. And in the last year, it has given everything back. And so, in reality, what you need to realize is that this market drop that we have had is going to be very important to the next big move up that we are going to have. And so, when the market has had this drop as it has had right now, why try to cherry pick stocks anyway? Why not go for the full basket of stocks? That's why I'm saying the exchange traded fund of the S&P 500, to me, I think is a very cool environment, because of every 3 months, if every 4 months, you can incrementally buy 10 shares or whatever you can or afford to buy. They pay out handsome dividends. When the market does have its next big bull run, you're already strategically positioned to be able to capture this really cool move to the upside.
Well, the thing is, people are also saying that it might be a bit of a long drawn affair. We're all expecting next year to be a bad year. So does that mean then I have to have cash that I don't need for the next year that I can put into this?
Excellent. Well, in reality, this is a great point. In terms of how long and drawn out it could be, it really looks like it was pretty bad for a while. And people are saying, well, when is the worst? Well, we're in the worst. I mean, we really are. So when you realize that last month, 500,000 people lost their jobs, and the fact that the automakers are days away from maybe filing bankruptcy, you can kind of assess that we're fairly close, or we're kind of living in this really hard time. However, we do have policymakers that are taking action, Federal Reserve doing everything that they can. We have this new administration that's coming on board. So while it seems as though it could have been a fairly long, drawn out, you know, recessionary environment, it doesn't look like it's going to be as long and drawn out as it could have been. It's not going to turn on a dime either. So just realize you cannot really effectively time these bottoms, and you cannot really effectively time these tops.
What's your guess? 6 months?
Oh, I would say another year or so, yeah.
Okay.
But you know what? That's okay. That's okay, because the average individual that understands how the market behaves, and depending on how much time you have to retirement, the younger you are, the more capital you could put in the market, the less time you have to retirement, the less capital you should have in the market.
What about the, when we talk about specific products out there, some people are really fearful of investing with banks now. What is your take on that? Do you think it's still a good industry to be banking on?
Well, in terms of the counters, I don't think they're a good idea at all. But in terms of having it be an institution that you can rely upon to be able to place your capital, I think it's a great idea. I know people probably are thinking about, well, Lehman was not that great of an idea, but Lehman was not a bank. They did not fall under banking regulatory requirements. They're an investment banker. And so when you hear the word investment of any type, whether it's an investment of properties, investment of securities, investment of any type, secure investments in and of themselves carry risk. Realize that. But when we're talking to put your monies into an institution, a banking institution that has, you know, federal, insurance. Now you know, I know in the U.S. you can place $250,000 in a bank and it is protected. A couple can put $500,000 in a bank.
Right.
Which are the industries you would recommend then?
And in this
that
present
usually
time,
do well, during recession periods.
Defensive stocks always do well. I mean, stocks that are, people will still go out and buy toothpaste. Household products are still always going to do well, exactly. I would not consider buying home building stocks at this time. I would not consider banking stocks at this time. I would not consider oil stocks at this time. So there are certain sectors that are probably not going to turn around on a dime. I'm not going to try to perfectly time their entry, but defensive stocks are always the place to be.
What about people who are fresh into the stock market, who are thinking, well, now's the time to start to dabble a little bit? Do you think they should go in now, or should they be a bit more concerned because they're sort of rookie investors?
Well, yeah, and again, it depends on how much time they have. And your point is, when will I need this capital to live? And so, for example, if this is capital that you're going to need to live in for the next 5 years, you really should not consider putting it in a market at all. Keep it into an interest-bearing, or a money-making, interest return type of an instrument. But if you feel like, well, I don't need this money for another 15 or 20 years, you see, this is where you can do that incremental purchase of, these exchange-traded funds where you don't have to cherry-pick the stocks, where you can average cost your ownership of these instruments, and when the market decides to make a nice, cool move to the upside, you're perfectly strategically positioned. Always set aside capital that you can invest, depending on how much time you have to retirement, and always have a set aside monies that are for zero risk.
Right. Well, at extraordinary times like this, should your strategy towards investing be any different from what you used to say before? Because I remember you were telling me that you shouldn't be looking at your stock market movements every minute, every hour, but just take 10 minutes at the end of the day to have a look at it and then make objective views. But, we're in a situation right now where news is breaking, and with each news breaking, the whole market just reacts, crazily.
Yes, and you can see 300 points up on the Dow is given back completely the very next day. And so basically for me, in terms of time horizons, my time horizon, the longest time horizon that I consider being in a trade, is typically only about 3 weeks. And so if I can position myself to capitalize on a 10% move on a stock in a 3-week window of time, and then I can extract my monies off the table and then position myself to do it again, that is what I'm talking about, where these are not instruments that I need to look at every minute or every second or every day. So my long style horizon is about 3 weeks in reality. After that, I really don't know what type of fluctuations the market can have. So that's how come I say, choose what time horizon you're choosing. When you know what time horizon you're going to be in, respect that time horizon, exit your trade, and simply now look to do it again.
And you know what? I think sometimes because we are so scared of losing that money, it's money we need. That's why we're looking at every minute of the day. So that already is a bad move, as you mentioned. Don't use the money that you need on a day-to-day basis.
That is exactly the point. Exactly. There should be capital in your account that is considered zero risk, and there's capital that you have in your account that's considered, investment risk. And so when you can separate the two and know, well, I don't need this money for quite some time, I'll be okay leaving it in the market, and depending on my time horizon, my strategy that I'm going to use, let it grow. Exactly.
And don't let your emotions get into play as
well.
well.
And don't put your whole entire capital in one stock.
I know.
Thank you so much, Mirriam, for coming in this morning.
Pleasure.
Mirriam Macwilliams, millionaire trader, with her tips on how to make the best out of the stock market.
We're going to take a quick break here on Primetime Morning, but keep it on the channel. Back in just a bit.